Today we're going to be talking about how the ceasefire in Iran is influencing Canadian mortgage rates. We're going to start off with that, talk about what is being expected now from the big six banks, what they're forecasting from the Bank of Canada, and then we're going to follow up talking about some smoking hot mortgage rates as low as 3.25% for a 5-year, and exactly who is eligible for it. As we all know, when this war in Iran started, bond yields, which are one of the key influencers of fixed mortgage rates, took an immediate spike upward, which resulted in some relatively respectable increases to fixed mortgage rates. Now, when the ceasefire was announced, bond yields dropped. Actually, the bond yields had been on a downward trend since about mid-May, but not enough to see any radical drops. We saw a couple lenders drop their rates. This is before the ceasefire was announced. Then when the ceasefire was announced, we did see a big dip in bond yields that day, but we haven't seen it drop enough yet to see any notable drops to fixed mortgage rates across the board. So we need to see the yields drop further before that happens. Now, the whole reason why rates increased, again, is not so much just the war, but it's the fact that it crippled the flow of gas. The Middle East is kind of like the world's gas station. So when you close the Strait of Hormuz, that is crippling the oil flow out of the Middle East, which is what's driven up gas prices. Now, the strait is open, but we don't know for how long. There's still a lot of details that need to be hashed out with this US-Iran agreement, which seems to be like Iran is getting everything that they want here, and it doesn't seem like the US will be in a better position, or the world for that matter, after this thing is all said and done, but we'll see. A lot still has to be decided here. So, like I said, yields did drop, but not enough to warrant any cuts. Tensions between the US and Iran still remain elevated, so we are not out of the woods yet. And that's part of the reasons why bond yields have not fallen further. Once it looks like we're out of the woods and the strait is fully open, and even when it does fully open, it is going to take some time for it to resume to normalcy. It's still going to be a little bit slow as ships may be a little bit cautious still going through there. So things are looking promising, but the whole geopolitical landscape still remains quite volatile, which means there is still a tremendous amount of uncertainty out there. And that uncertainty is really not going to go away as long as Donald Trump is in the White House, because we really don't know what the heck he's going to do or what he's going to do next. It just single tweet from him, do they still call them tweets? Single tweet from him or post from him can move bond yields in one direction or another. They react, which can have an impact on rates. So now sometimes the bond yield will react or overreact, and then they jump up and then they fall back down, or they plummet and then move back up again. So the bond market, like the stock market, can be a little hypersensitive to news sometimes, and sometimes it does in fact overreact. Now, let's talk about what the big six banks are forecasting. Now, there really hasn't been a lot of changes since the beginning of the year. We look at CIBC, they are forecasting a 0.25% hike in the first quarter of 2027, followed by another one in the third quarter. RBC is forecasting a 0.25% hike in each of the 4 quarters in 2027, nothing for 2026. Scotiabank is actually the only bank that is forecasting a hike in 2026. And they're predicting a 0.5% hike in the fourth quarter this year, followed by another 0.25% in the first quarter of next year. We have both TD and BMO, who are the most optimistic. They believe that there's going to be no changes through to the end of 2027. And then last, we have National Bank, who are forecasting a 0.25% cut in the first quarter of 2027, followed by another one in the second quarter of 2027. Now, as you always hear me say, these are just forecasts. Look at them as if they're long-term weather forecasts. They can and do change. However, they really haven't changed much since the start of the year, as I mentioned. So we'll see how things move forward. Now, it was just last week when the US had their central bank rate announcement, which they left things unchanged, which is exactly what was expected down there. However, they did hint that they very well may need to hike their rate by the end of this year. That resulted in the stock market plummeting and bond yields rising, but not enough that we need to be concerned about. They jumped and then they came back down a little bit. So nothing really to be concerned about there. Sometimes on news like that, the yields could keep rising. We don't always know exactly how they're going to react. All we can do is kind of interpret the information and what we see. So that's what the big six banks are forecasting. It is possible that some of these forecasts will be updated because a lot of these are prior to last week's announcement from the US Fed. So we'll see if they make any adjustments as a result of that. It's possible they will. We'll know over the next few weeks. And as soon as we have that information, as soon as all the forecasts are updated, I will bring them to you once again. Now let's talk about these smoking hot rate promotions that we have available. Now there are 5-year variable rates as low as 3.25%. That's prime minus 1.20%. The last time we saw a discount on a variable rate mortgage by this margin was way back in 2021. But now prime minus 1.2, we haven't seen that in quite some time. This is for insured purchases, or if you have a purchase where the purchase price is under $1 million, so $999,999 or less, and you have a 35% down payment and your mortgage amount is a minimum $400,000, you will be eligible for the prime minus 3.25. Now the fixed rates, the 3-year fixed is 3.94. Again, that's for an insured purchase, or the 5-year is 3.89, again, for an insured purchase. Now, if you're purchasing again, under $1 million, 35% down payment, the fixed rates are just going to be 0.05% higher. So 3.99 for the 3-year and 3.94 for the 5-year. Now, what if you have a mortgage coming up for renewal? Because we have an insane amount of mortgages coming up for renewal right now. We have all the people who took 5-year terms back in 2021 and who were enjoying these super low 1% rates. And we have all the people who took the 3-year in 2023, which was the most popular product at that time because it was expected that fixed rates would drop. And sure enough, they did. Here we are with lower rates today. So if you have a mortgage coming up for renewal, some of these rates you still will be eligible for some situations. And on mortgage transfers, it can become a lot more complicated in determining what the lowest rate is that you'll qualify for. There are so many factors, the original purchase price, the original purchase date, whether you refinanced at some point in between, when you refinanced, what the current value of the property is, the usage of the property, even the lender that we're switching you from can have an impact on what the lowest rate is. Now, in some cases, you will be eligible for the prime minus 1.2% on a mortgage transfer. For the fixed rates, the lowest 3 years, 3.99, the lowest 5 years, 3.99. Again, some situations. So you need to reach out to us at info@pmtmortgage.ca. And we'll ask you all these questions. We'll ask you to provide the information that I'm talking about now, the information that we need to determine what the lowest rate is that you'll be eligible for. And then we'll let you know what that is. And at PMT Mortgage, we are always trying to keep your rate as low as possible. We are very serious about getting you the lowest rate on the market. One last thing I wanted to add about these rates too is that they are for limited time only. We can see an increase to these at any time. The lender who is offering them put a firm cutoff date as June 30th. Now, lenders can always extend the promos. I do not expect this one to be extended. So June 30th is the cutoff, but the lender also has a certain pool of money that they can allocate for this product. So as soon as that pool of money dries up, as soon as they fill that bucket, then they will shut off the promo. So that could happen before June 30th. So the only way you're going to guarantee that you get in for this promo or the lowest rate that you're eligible for is to get something locked in as soon as possible. Now, if rate drops between now and your closing date, we will for sure make sure you get the lower rate. We're always monitoring the rates for our clients. Even if you've already signed, we can still get your rate lowered or even move you to another lender, providing there's enough time to do so. So we're always monitoring that for our clients, all part of the extra service we offer at PMT. That's about all I have to say for today. And I write a blog every Wednesday. You can read that at easy123mortgage.ca/blog. So all the information that we've discussed here today is included on that blog, including the forecast from the Bank of Canada for the big six banks on what's expected from the Bank of Canada and all the information that we've discussed and then some. So check that out. Again, if you have a mortgage coming up for renewal or a purchase closing within 120 days, reach out to us at info@pmtmortgage.ca, or you can call us the old-fashioned way, 647-368-5009.